Hi friends, welcome to Adda 24/7. We are in the most important questions and case study series for CAIIB. I'm covering ABM and BFM. You'll find other topics also ABFM, BRPL covered by other mentors. So watch the series till the end. Watch it for all the subjects. Watch this video also till the end. Share it with your friends. Share it on all your social media platforms. Like the channel, subscribe to the channel. Do it first. Okay, let's move on. Which of the following are eligible financial collaterals? Now understand one thing in BFM. Before going to the answers, let me explain you one important part. In BFM, the main financial collaterals means or main collateral only. Forget financial collateral. Important is collateral. In BFM, the collaterals considered are only financial. Suppose if I am taking a house, okay, so that is not considered as a collateral. If I am taking gold, that is not considered as a collateral for calculations. Of course, gold is there, gold haircuts are also there. But other than gold, physical collaterals are not considered. Here mainly we consider financial or documentary collateral like bonds, mutual funds, right? So which of the following are eligible financial collaterals? Mutual funds and equities, debt securities rated by chosen credit rating agencies, attracting 100%, this is 100%, or lesser risk weight, rated as triple B minus, minimum, this is at least triple B minus, which is when issued by the public sector. Kisan Vikas Patra, LIC policies, gold, etc. So which of these are considered as a eligible financial collaterals or documentary collaterals you can consider? It is. So the answer is all of them. Okay, 1, 2 and 3, all of them. See here, financial collaterals, all of these are considered for your under your BFM. Okay. Which of the following is a correct definition of Macaulay duration? Macaulay, firstly Macaulay, understand there are two durations. Okay, one is Macaulay, second is modified. Okay, modified. Both are important. It's not that one is important, other is not. Here Macaulay gives you what? Okay, that's already there in the answer. But what is modified then? Modified duration gives you for the percentage change of 1% in your base rate. Base rate means it can be a repo rate, it can be your benchmark, you can call it base or benchmark. 1% change in the benchmark rate. What is the price change in the bonds? Of course, they'll change in the negative direction, right? If the repo rate goes up, your price will go down. So what is the percentage change? Okay, that is considered under modified. And under Macaulay, basic I'll tell you about Macaulay. It is a period within the life of that bond in which the interest rate risk is zeroized. Interest rate risk. Okay. So it is defined as the weighted average time to cash flows of a bond, where the weights are nothing but present value of the cash flows themselves. So present value of the cash flows which are coming in future. So after all, net, what does it mean? Present value of the cash flows means whatever are the future funds which are coming in, these will be coupon plus these will be the maturity period, right? Maturity amount. All that whenever I take it at the present value. So net it comes to this interest rate zeroization. Okay. So this is one of the answer. This is true. Next, it is the net sum of cash inflows and cash outflows. Inflows and outflows. No, that is not the one, because that is called as NPV, net present value. Okay, it is a ratio between the fixed income portfolio's price sensitivity to the interest rate change. Portfolio versus interest rate change. Now this is also not the answer. This is VAR, value at risk. What is VAR? How much your portfolio changes with respect to the change in some benchmark rate, right? So that is VAR. It calculates the investment rate of return and annual growth rate. Investment rate of return means what? It is called as ARR, okay, annual rate of return. So it's a part of your payback method, payback, isn't it? So these are totally different. Payback method. Okay, and annual growth rate. So it is totally different. The answer is only this. Again, I'll tell you in simple language. I'll tell you what is Macaulay's duration. Macaulay means what? Where your interest rate risk is zero. Is zero. That is basically your Macaulay duration. Interest rate risk should be zero within the life of that bond. That is important. Okay. All these remaining things are totally different. See this, I have given it over here also. Macaulay modified. Okay. Macaulay means what? Look at this. All these definitions I have given. Okay. Move on. Chalo. Next one. Now match the following. Liquidity risk. So where will you match this? Risk related to purchasing power of the income. Purchasing power. Risk related to firm's capital structure. Risk related to inability to pay its dues on time. Risk related to fluctuations in profits. So what is the answer over here? Yeah. Risk related to, is it 1, 2, 3 or 4? See here. Let's do the explanation about this. Risk related to purchasing power. This is as good as inflation, isn't it? Inflation means this, purchasing power is reduced. Capital structure. This is related to a capital ratio, or you can call it as a capital risk. Okay. So this is not related to liquidity. Liquidity means day-to-day activities. Right? Day-to-day, I am not able to pay my electricity bills. I am not able to pay my EMIs. That is all liquidity. So related to inability to pay its dues on time. Yeah, this is true. Dues on time. Right? Related to fluctuations in profit. This is not one. This is again comes back to VAR. Okay, somewhere. So the answer for this A is 3. This is the answer, 3. Okay. Next one. Again, business risk. Business risk relates to purchasing power of income. Okay. So power. Related to firm's capital structure. Related to inability to pay the dues. So this is gone. Just now we saw it. So that is out. Risk related to fluctuations in profits. Now what can be the answer? This is inflation, right? Inflation. Now the answer remains between only 2 and 4. Firm's capital structure and risk related to fluctuations in profit. So capital structure is different. Capital structure is not related to business. Here, what is business risk? Business risk basically means your strategic mistakes. Means you are not able to think properly about the future. So what will that relate to? Suppose if you are not able to think properly about the future, what will it affect? It will affect your profits. Isn't it? Nokia, simple example, Nokia. Where is Nokia now? Nokia was once a leader in the mobile phones. Where is it now? Business risk. Okay. So the answer is 4th. Okay, 4th is the answer. Where's the cursor? Yeah. Next, financial risk. So it is what? Now it's easy, isn't it? Profits. Then dues, that is liquidity risk. Now only between 1 and 2. What did I say about the first one? Purchasing power. It is inflation, right? So inflation. So now what remains? Last one remaining is only this. So this is the answer. Capital structure. Okay, let me explain you. Look at this. Capital structure consists of 3 types of capitals: T1, T2 and T3. Tier 1, Tier 2 and Tier 3. Okay. Tier 1 is known as the free capital. That is a part of your financial risk. Tier 1 is known as free capital. Tier 2 is the paid capital, or going concern, gone concern we call it. T3 is the emergency capital. Okay. So these are the basic capital structures, and this is the part of your finance only, financial risk. Got it? Now before going ahead, everyone kindly subscribe to Officers Adda English channel as well as the Hindi channel, bilingual. Okay, both the channels. Subscribe to it, click on the bell icon immediately. Join the crash course coming up on 11th October. immediately join this. All important points are covered. Case studies, numericals, everything is covered. You can join the Mahapack also. In Mahapack, you will be getting multiple batches, and right now you are getting double validity, DV. Okay. Double validity means what? Okay, I'll show you at the end. What is double validity? Okay. So at the end, I'll give you all the details. So let's move on to the questions. Which of the following statement about the correspondent banks is not true? Now, correspondent banks is not true. Firstly, what are correspondent banks? Correspondent banks means those banks which act as an agent of yours. For example, let me give you an example. Suppose SBI. SBI is in India. Now, if SBI wants to do some transaction in, let's say, some other country, let's say USA. Now, I'm giving you an example. SBI wants to do a transaction in, let's say, USA. Okay. Now I'm assuming, here I know SBI is having a branch in New York also, but I'm assuming if SBI is not having the branch in USA, but it wants to do the transaction in USA. So what will it do? It will appoint some bank over there, Citibank, let's say example, Citibank as its agent. Okay. It will appoint Citibank as its agent, and this bank, when it acts as an agent, it's called as a correspondent banking. Okay. So now we got it, correspondent banking. Now let's look at the options. Correspondent bank provides services as agents for collection of export-import bills as well as checks in their country. Okay, number one. Correspondent bank uses only a single currency for the transaction. Now you want not true. Look at this. You want not true. Uses only a single currency for the transaction. Correspondent bank acts as a middleman between the financial institutions, and all of the above are true. Now we want not true. Okay. So which of them can be the answer over here? Think over it. Everyone think. You want not true. Which of them is not true? See here. Forget this. This option is this. Somebody might say D is not true because all of the above are not true. So forget D. Don't look at D. Okay. D is totally it's irrelevant. Consider between A, B, and C. Which of them is not true? Correspondent bank provides services as agents for collection of export-import bills as well as checks in their country. So agent for collection, what did I say? SBI will appoint Citibank as its agent. So they will act as an agent. So that is true. Correspondent bank uses a single currency. What is this logic? There is nothing, no logic of single currency over here. Correspondent bank has nothing to do with the currency. It can use single or multiple currency, whatever it is, depending on what relationships or what transaction is happening. Okay, it has nothing to do with this. So this is false. Correspondent bank acts as a middleman between the two financial institutions. That is true. Okay, so it acts as a middleman is the wrong word actually. Men is the wrong word. It should be a middle person, or you can call it as a liaison. Liaison. Okay, Liaison. Okay, liaison means the person who connects the two. Okay, so got the answer? Answer is false. That is B is the correct answer. Which one is not true? So this is B is not true. UCP 600 defines original documents with more precision. According to UCP 600, which of the following is considered as the original document? What is considered as the original document? Now first, what is UCP 600? Now look at this. In your CAIIB studies, you have almost 5 types of studies or topics for your this module A. One is UCP 600. Okay. Second is ISP 98. Third is URR 725. ISBP also you have. ISBP 745. Now it's not 745. Now it's 821. 821. So these 4 you have. There is one more EUCP, but I don't think so that much is there for you. 2.1. This is the main. These 5 subjects are there for your CDCS exam. Those who want to give some foreign exchange trade, means trade finance, for them this CDCS is important. So mainly you have these four. Okay, UCP 2.1 is not there for you. So UCP 600, EUCP 2.1 is not there. So UCP 600 is what? UCP 600 is the governing document, or it has 39 articles. It is one of the governing document for the LCs, letter of credits, in international trade mainly. Okay, so it is there for even local LCs also it's applicable, but internationally it's used more. So now let's come to the question. UCP 600 defines documents as original. So which one is original? Any document bearing an apparently original signature, mark, stamp or label of the issuer of the document, unless the document itself indicates it is not original. Any document that appears to be written, typed, perforated, stamped by the document's issuers, means written. Suppose if I write something, so is it original? Any document that appears to be on the document issuer's original stationery, and all of the above. So which of the document will you consider as original? Suppose if you get something like this, you are in the bank, let's say, and you get some document like this. So in that case, what will you consider it as the original? Which one will you consider? Any document marked, stamped, signature, mark, stamp, label, anything which is done, means there is a document and I sign on it, or I put a original stamp on it. So is it original? Yes, it is original. Yes. Any document that is written by me, written, typed by me, means you come to know that it's typed by me. So it is original. Yes. Any document that appears to be on the document issuer's original stationery. Suppose if something is on my original letterhead, then also it's considered as original. So the answer is D, all of the above. Okay. To give you more explanation on this, look at this. There are total 39 articles in UCP. Out of them, Article 17 defines the original documents. Article 17. So Article 17 defines the original documents, as any document bearing apparently original signature, mark, stamp, label of the issuer of the document, unless the document itself says it's not original. Means document says it's a copy, then it's okay, then it's copy. Okay. Or any document that appears to be handwritten, this typed, perforated or stamped, or any document that appears to be on the letterhead of that issuer. Okay. So in Article 17 defines this correctly. Got it? Which of the following is a capital instrument permitted for receiving foreign investment in Indian companies? Foreign investment in Indian companies, capital instrument. Government, now Indian company, okay, we are not talking of government over here, we are talking of company. Government securities, T-bills, equity shares and all of the above. Simple one, quite simple. This is a JAIIB question, I think so, isn't it? Right? What is the answer? In the comment section. Everyone type in the comment section. What is the answer over here? It is C, equity shares, isn't it? Here we are talking of company over here, right? When we are talking of company, company means what? It is limited by shares. So anyone who wants to invest in that company will invest in shares. Okay. Now what are the other options given? Government securities. So this is for the government. Okay. Government securities is for the government. Now look at this. I'll give you some explanation for this also. See, these two are generally issued by the government only. Government securities are generally, I tell you, beyond 1 year, greater than 1 year. Means any bond which is issued by the government beyond 1 year is called as government securities. And any bond which is issued by the government up to 364 days, means let's say equal to, less than or equal to 1 year. So that's called as a T-bill. These are all like the current assets, okay, short-term instruments, and these are the long-term instruments. Got it? But that is for the government. Here we are talking about Indian company. So company means equity shares. Got it? When a bank provides a loan of 1.5 crores in accordance with the RBI guidelines, big question, very big. Loan of 1.5 crores in accordance with the RBI guidelines for a period of 5 years at a rate of interest of 1% over BPLR. So base rate prime lending rate. Okay, base prime lending rate. So over 1% over BPLR of the bank. At present, BPLR is 9%. The loan shall be repaid in 4 yearly installments in a 1-year moratorium. With a 1-year moratorium. Okay, 4 yearly installments with a 1-year moratorium. Funding of the loan shall be done from a deposit of 3 years of the same amount. The interest rate being 6%. Okay. What kind of risk is associated with such a loan given? Firstly, have you got the question? There are two things. Okay. One is loan, and second is deposit. Okay. Now for any loan, I need an equal amount of deposit. Simple. Keep it that simple. Okay. So let's talk about the loan first. Loan for a period of 5 years at a rate of 1% over BPLR. So period is what? 5 years. 5 years. The loan will be repaid in 4 installments, yearly installments with 1-year moratorium. So 1 year it is moratorium. I have given the loan today. Up to 1 year no repayment. Then in 4 installments, 1, 2, 3 and 4. So total there are 5 years. Okay. So 1 year is a moratorium. Yes. So up to 1 year no repayment. So now in this case what do we do? There will be one more, it seems. Yeah, 5. So now in this case, see this. What is the deposit? Deposit is of how many years? Funding 3 years. See this. Deposit is of 3 years. So now deposit is of 3 years. 3 years. 1, 2 and 3. And loan is of 5 years. So what is the risk this bank will be facing? Remaining everything is seeming to be okay. BPLR rate is 9%. So 9 plus 1, 10. Rate is not that much issue over here. So which is the risk this bank will be facing? Funding risk, liquidity risk, reinvestment risk, embedded option risk. Okay, let's look at the rate also. 1% over BPLR. BPLR is 9. So what is the rate of the loan? 9 plus 1. Right? And what is the rate of deposit? Interest being at 6%. So 6% is the deposit. So there it seems to be okay. Means I am giving the deposit at 6%. Okay, means I'm paying 6% and I'm getting 10%. So this amount is seeming to be okay. Means the rate of interest is okay. Only the problem is of the period. Now because of this period, what type of risk will I face? Funding. Of course funding risk will be there. Why? Because this depositor will come to me after 3 years. Once this guy comes to me after 3 years, from where will I pay that customer? Because this loan holder will give me the money after 5 years. Right? So funding risk I'll be facing. Second, liquidity risk. Will I be facing? Yes. What is liquidity risk? I am not able to pay the depositor, the principal, okay, because of the lack of funds. So that is liquidity. So that is also there. Reinvestment risk, that will also be there. How come reinvestment risk? Reinvestment risk means suppose if I get this deposit over here at 6%, okay, after the end of the 3 years, will I be able to get another deposit at the same rate, or will it be higher rate? So that is also there. Embedded reinvestment. What is embedded option? Embedded option can be there in all the both the things, deposit as well as the loan. Means I'll tell you the simple example. This person, a loan holder, he has taken the loan for 5 years, but this person can come tomorrow also. Forget this moratorium period. This customer will come tomorrow only within the moratorium period. He might come there and tell you that, see, I am having the money now and I want to repay it. So that is known as embedded option risk. Similarly, deposit holder. This deposit is for 3 years, but tomorrow, within 1 year only, this deposit holder will come to you. Sir, this is your receipt and I want my money back. You can't say anything. You have to give the money back. So that is embedded option risk. So answer is all of the above. D. All of them are right. Got it? Why all of them are right? Because all the risks do exist over here. So kindly know these, all the risks very correctly, because they are very important, all of them. Now, as I told you before going, I'll be showing you how to join the Adda 24/7 classes. Go to Adda 24/7. I'll always suggest you to go through the app. In the app, you get 1% extra using the coin systems. Okay? So go to Adda 24/7. Say this. Click on JAIIB and CAIIB. Okay? Click on JAIIB and CAIIB over here. Click on CAIIB November. See this crash course. Join the crash course immediately. Click on buy now. See this ebooks, test series, everything you are getting. Click on buy now. Put the code Y432. Y432. Click on apply. 77% discount you are getting plus 1% using the app. So 78%. Don't miss it.